Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 349th VideoCast podcast for the week ending June 25th, 2026, live from Pinehurst, North Carolina. It's been a busy week and want to get right down to it. As I promised, this week's would be shorter than normal, but will be action-packed with data, as always, family first. So, Annabelle received a nice shout out from the International Swim Coaches Association, recognizing her for maintaining her #1 overall ranking in the USA throughout her 11-year-old swimming season. Annabelle also had the opportunity to video chat with Olympic gold medalist Tori Husk. Tori is a 5-time Olympic medalist, and she recently graduated from Stanford University, Annabelle's goal. Annabelle was thrilled to have the opportunity to learn from such an accomplished mentor. As if that wasn't enough, Tori also sent Annabelle one of her prelim swim caps from the Paris 2024 Olympics. If you recall, Annabelle received Tori's finals Olympic swim cap at the Orca Awards, and now she has her prelims Olympic cap as well. We are so grateful to Tori for her kindness. She truly embodies the essence of a class act. So there's Happy Annabelle with this merch from Tori. And there is the Orca age group leaders with Annabelle. And what else do we have here? That's her video chat with Tori. And there's Tori Husk, Olympian 2020, 3 golds, 3 silvers, complete rock star. And then had quite an amazing full week. I've been down in Pinehurst all week with 24 friends from Newport. We had an incredible time. We played number 4, number 7, number 10, number 8, and number 2. I would just say number 4 was probably my favorite, followed by number 2. Number 2 was my best score today. Shot an 82 at number 2, which is a big deal because I'm, not that great. And as scratch golfers struggle to break 80 at number 2, they have the turtleback green. So it was a lucky day. It was a good day. Very grateful for that. A lot of friends stuff. The previous 2 days, nothing to really write home about that other than a great time and great experience. But I would just say, if you get down to Pinehurst, definitely play number 4. Play the new course at number 10 was absolutely amazing. Play number 2. And I'd also play number 8 if the greens have not just been sanded and punched, because number 8 is a pretty cool course as well. So that's that. And then that was New York City. That's the Louis Vuitton. That was with my buddies in Connecticut at my club out there, and a friend was in from California, Jason, my buddy Blake, and his friend, and that is number 7. Brian Schneider just redid the whole course. It was finally finished, first time playing it. Absolutely incredible. Any golfers out there, clients, etc., when I'm on the East Coast, we got to get up there and play because they did an unbelievable job. That's some friends out in Pinehurst. As always, John, Daryl, Blake, etc. walking down. That's one of the new course holes yesterday. That's the Bryson DeChambeau plaque. Justin and Robin, thank you so much. And then I'm going to be out in San Francisco on August 25th through the 28th for the Money Show. If you are in the area or you want to come, I'll be doing 3 segments. Go to hedgefundtips.com. Just scroll down till you find Money Show Appearance, or put that in the search bar here, and that'll take you to their website where you can get your tickets, or just go to their website and get your tickets. There's my schedule. Again, August 25th to 28th. Also, if you are a client or a potential client and want to meet up in person in San Francisco, that would be a good time to do it. So definitely check that out. On to the next quotes of the week. Everyone has the brain power to make money in stocks. Not everyone has the stomach. If you're susceptible to selling everything in a panic, you ought to avoid stocks and mutual funds altogether. That's from Peter Lynch. And then Charlie Munger says, it's the waiting that helps you as an investor, and a lot of people just can't stand to wait. That is our edge. Want to acknowledge all the people who have been sharing the podcast. You're making a difference. Big shout out to Nate, who introduced me to Ken, who's coming in at the next quarterly opening. And that all came from wearing your merch and sharing what we ask. This was originally started as a way for me to communicate to clients about positions in the portfolio. 7 years ago, we opened it up to the public. It's been a big hit. And all we ask is each week, share it with one person you care about that would benefit from this. As long as we keep growing, we'll keep it open for non-clients. And you guys have been knocking the cover off the ball with the sharing. Want to acknowledge Mikhail Bobkov and James Stawicki for sending in their picture. I did not think we were going to sell this shirt with my face on the shirt, but they bought it. They're wearing it. Honestly, they look really good. I mean, we had one person in the comments section of the YouTube videos for 5 weeks straight kept saying, please get a shirt with your face on it. And I said, I wouldn't even wear that. Why would you want that in a million years? But they're selling. So very grateful for that. You're definitely going to get questions off that. Tell them to tune in to Hedge Fund Tips with Tom Hayes each week, like Mikhail and James. Andrew, thanks for setting in your mug, the Hedge Fund Tips with your Vans jacket on, and so on and so forth. But as always, we're getting tons of orders. We're not getting tons of pictures. So please send them to info@hedgefundtips.com. You could always email us back in the future and say, hey, I want to take my picture off your website. We'll take your picture off the website. But let's keep the community growing. Share that. And while you're at hedgefundtips.com, click on terms. This is all opinion, not advice. All right, want to get down to some stuff because we were very early saying Mag 7 was going to take a breather. And that's happened in spades. You see Apple down from 317 down to 275. You see Amazon from 278 down to 227. You see Google down from 408 down to 340. You see MAGS, which is the ETF for it, down from 71 to 61. That's almost 15%, 71 to 61, so 10. That's almost 50, that's like 15%. You see Meta down from 793 to 550. This was an unpopular opinion when we were pounding the table on it in 2025. Took a little while. Microsoft down from 551 down to 350. That's a huge drop, like 30%. Then you've got Netflix down from 134 down to 70. That's almost 50% drop. You got Nvidia down from 236 to 195. But really, you got to go back all the way a year. The stock has done nothing. While Intel was up 5x. Palantir has fallen off at 207 down to 107. So that's almost 50% off. Tesla from 498 down to 375. And now, most recently, SpaceX is coming back down to earth, literally and figuratively, has dropped from daily, and here we go, from 225 down to 153, and they haven't even opened it for the selling from the insiders. So more coming to a theater near you. The next thing will be the AI trade cooling off. And after an earnings report like Micron last night, no one can see that. I'm telling you, like I told you last year, that trade, the air is going to come out. I looked at 3,000 stocks this weekend. It's never been more clear. I mean, you're already seeing the Siennas crack. A lot of these names start to crack, and these will be the last ones, final gasp of breath, and people will be surprised and they're going to get hurt. So if you look at Sienna down from 635 to 484, that was a huge part of it. And that one was absolutely parabolic. They're all starting to break. And as you remember in 2000, it's like, it's not overnight. It's many months of up and down, fighting, because there's all that excitement, all that parabola in it. And there's like 3 dozen like this that are all starting to crack. And you say, well, how's that possible? The prices are going up, the demands are going up. 2 things are going to happen. The Mag 7 is telling you what's going to happen. They're the ones creating all of the orders for the chips. And everyone says, well, then just buy the chips. The hyperscalers are the suckers. The chips are going to be the winners, except for the fact that the stocks are down so dramatically on the hyperscalers who have borrowed, who have run out of free cash flow. So now they've had to issue debt. Now they're issuing equity. Now they're afraid to issue equity. The next phase, when you've got a stock down that's 30% like Microsoft, 50%, etc., is they're going to have to claw back on their commitments, which you're going to see in Q2 earnings. And once one of them claws back on their spending commitments, the entire semiconductor basket is going to be train wrecked, even if sales are going up and earnings are going up in the short term. Why? Because the market is a discounting mechanism. And when you're that far out on the skinny branches, any little breeze, you don't need a hurricane, is enough to snap the branch and have everyone running for the exit. So just like everyone looked cockeyed at me talking about Mag 7 last year, the same will be true about the AI trade and semiconductor crowding over the next 6 months. And defensives are going to rip. And we're starting to see that already. Moving along, this chart here is the hyperscalers. This is the red line relative to the semiconductors, which is the green line. And you can see, just like when Zuckerberg was spending so much money on the metaverse and everyone sold the stock in the hole, and he said, no, we're going to keep spending, until it went down enough that he had to blink and he had to say, metaverse, we're going to stop spending. And then the stock went right up. The same will be true for the hyperscalers. And once that happens, the hyperscalers will stop going down and the AI semi-trade will collapse. Not because their earnings won't be up, not because price of DRAM won't go up for a few quarters before they get over excess capacity in coming quarters, because the market is a discounting mechanism. You're late to the show, and the show is going to end with a homicide, and hopefully it's not you. Next, I had a good friend email me, and client, that said, by the way, this is a client who, he has a big account, probably made $2 to $3 million on the Alibaba options that we took off at 7x last year, by the way. But he asked a question, because obviously the stock is going down. He said, Tom, does corporate behavior play any role in your view of a company? And he sent me the article. Anthropic claims Alibaba ran, quote unquote, brazen campaign to access its Claude AI model. And I think it's a super question. And I thought about it a lot. I started to think, well, we own Diageo, do we feel good about like people who, don't have positive outcomes or abuse what they sell? No, we don't feel good. But, here's my answer. Okay. As it relates to the Anthropic claims about Alibaba signing up 28 million accounts and reverse engineering their thing, I said, look, first off, it's an accusation at this point. Do I doubt they did it? No, I don't doubt they did it, but it's an accusation at this point. I'm not paid for making moral judgments about companies. I'm only paid for growing clients' money, period. That said, I do have some limits. I don't invest in, weed companies and other things, in part because I just don't think they're good businesses. There are ways to make money in those industries, but public companies don't tend to be it. Second thing I said was, if they have done something wrong, like, for example, a restaurateur dining at a competitor's establishment and then copying the best-selling entree, which happens every day of the week around the world, they will be appropriately punished if it's against the law. If it is normal competitive reconnaissance, that's pretty standard business practice on the battlefield. I mean, if you're not paying attention to your customers and making sure they're not getting ahead and, looking at some of the better ideas that you could adopt, then you're probably going to get left behind. So we have to have exposure to AI. We did it with Intel, but price got ahead of value and we took profits. In the case of Alibaba, it's a call option on the future of AI in Asia, which will be, and probably Europe as well, and Africa, which will probably be which will definitely be an enormous business. We cannot cut bait on a headline or two. Do I wish the headlines were better? Yes. However, this too shall pass. We'll talk a little bit more about Alibaba this week. But, we basically made enough with the options last year that our whole basis was paid for. So it could go to zero and we would make money on the Alibaba trade. That said, nothing's changed in our thesis. And over time, I think it's going to be a phenomenal investment with the stock that we continue to have, despite having taken the profits on the options last year and having very limited option exposure prospectively. So why? Because we didn't know how long the next phase would take. And as we covered last week, this is kind of par for the course for taking out all the money that, we're selling at 60, buying at 190. They get puked out just like they do every time. This is very, very similar to 2018 to 19. You had this parabolic move from 54 to 200, just like we had this parabolic move from 54 to 190. Then you checked all the way back down to the low hundreds, just like we're doing now, before taking the next leg higher to 300, which I expect we will do in coming years, simply because they are in all the sweet spots of what's going to be working in coming years. I don't know about minutes. I don't know about days. I don't know about weeks. I don't know about months. But years, this is a slam dunk in our opinion. The second thing is that obviously people were worried about Alibaba got put on the military list. They do business with their military. No shit. So does Amazon. Wake up and smell the coffee. Amazon does business with our military. Palantir does business with our military. Does China put them on a list because they do business with U.S. military? No. So it's a still, it's silly season. It's like it's a negotiation. It's playing childish games. But here's the thing: Tencent Holdings, which has done just fine, China's leading games and social media company, has been on that military list for over a year, and the stock's done fine when China stocks were doing fine. Right now, China stocks are not doing great, so none of them are doing great. Whether they're on, the U.S. administration's military list or not military list, it doesn't change the fact that Chinese middle class are going to buy stuff. Alibaba is going to collect the toll. They are going to use AI. Alibaba is going to collect the toll. They're going to use compute. Alibaba is going to collect the toll. So if you think being on a list is going to stop them from providing, hundreds of billions of dollars of that value, then, you're smoking the cannabis stocks that we won't buy. Moving on to the next. Hyperscaler free cash flow projection, absolutely falling through the floor. And you're starting to see it. The other thing that no one's paying much attention to is AI token price is collapsing. It's hitting big tech valuations. And the market is in this fantasy that if token prices keep collapsing because companies are getting the bills for using that, and they're now dialing back because they don't see the immediate return on investment or the immediate increase in productivity, or they do a simple calculation that humans are cheaper, that's going to scale back the hyperscalers' commitments. So for everyone thinks they can hide out in semiconductors because semiconductors are selling all this stuff to hyperscalers. Well, if hyperscalers aren't getting a return, guess what they're going to stop doing? It is the level of spending that they're committing to. They're not going to stop spending because it's defensive spending. They're afraid of losing share. But if they all stop because they're not getting a return and the board and the shareholders force them to, these things are going to just absolute trap door on all the people chasing them up. And all the gamma squeeze is going to be over, and it's going to be GameStop part 2. All right, hyperscaler stocks are increasingly tracking AI token prices as investors worry that pricing power for advanced AI models is weakening. Falling token, and by the way, they're pulling the OpenAI IPO apparently until next year or till fall or next year. Falling token costs are raising concerns about AI profitability and the returns on massive data center investments, putting pressure on big tech valuations. You're seeing it in private credit, who lent a bunch on software and depreciating chips. That chicken is going to come home to roost as well in the private credit markets. S&P 500 consensus expected long-term earnings growth. The last 2 times you saw expectations this high were tech peaks in 2021 and 2000, and they didn't turn out to be true. So coming to a theater near you. This is Compute H100 price index, collapsing almost down a third in the last 2 weeks. QQQ, only other time in history with a 10-day return of 0%, despite there being 9 out of 10 days with a plus minus of 1% return. According to OddStats, was 2001, again, near a tech peak. Hyperscaler, less chip stock, free cash flow, collapsing. Stocks reach all-time high valuations, again, concentrated in the AI trade, higher than the dot-com bubble when you consider trailing PE, forward PE, CAPE, price to book, price to sales, enterprise value to EBITDA, Q ratio, market cap to GDP, ROE, etc. Then you go back to the Nifty 50 in 1965. Then you go back to 1929. I'm not calling for that type of correction, but I think on a isolated sector crowded trade basis, you could see some real pain coming to people who are crowded late. And margin debt expansion versus contraction indicator, you're seeing it here. LLM token prices starting to fall as cost-conscious users shift to cheaper models. You know where they're shifting to? They're shifting to China models. We're going to talk about that later. Semiconductor ETF weekly inflows. This always ends well, just like in 2021, and then boom, roll over. Kovalevsky letter, markets driven by 2 sectors. S&P 500 has added $5 trillion in market cap. AI stock, $6 trillion, followed by at the same time, other sectors have erased $1 trillion. Majority of market gains have come from 84 firms. 47 AI-related stocks now reflect 47% of the S&P market cap. AI is all that matters until it doesn't, and when it does, when someone yells fire and everyone tries to get out of the exit all at once, you're going to see the dumbest companies, hint hint, companies that sell peanuts and protein snacks double, like literally overnight. People are going to panic into infusion pump companies that do anesthetics and IV bags. Okay, they're not going to be able to get enough IV bags. They're not going to be able to get enough Guinness Beer Company. Boring stuff that you can't give away right now are going to be doubles, and people are going to be panic buying into them, just like they were when Buffett was buying them all after 2000, when everyone said Buffett's lost his touch. He's not in tech. He's not in Global Crossing. He's not in Enron. He's not in Cisco. He's not in Amazon. And they were all down 90% if they stayed in business. Half of them were frauds. So coming to a theater near you. Okay, forward 12-month consensus EPS. Again, same type of story. Defensiveness of the S&P 500. Again, you can't give away any defensives. This is a once in a generation opportunity to buy defensives. You have not seen this level of relative low valuation in staples, healthcare, REITs, and utilities since 2000. It was the opportunity of the century. So now you got 2 opportunities of the century, and you're positioned for it. We're there. So collect your dividends, whether it's 6% in Hormel and 5% in Crown Castle, and across the board, and you get paid while you wait. Mark to market will be volatile until it doubles. And then everyone will say, oh, why didn't we buy defensives like they did in 2001, 2002, 2003, 2004 when Buffett left everyone in the dust and they were licking their wounds. And by the way, some of the biggest zealots of the AI trade right now were some of the biggest zealots of the internet trade in the late 2000s. And the ones that didn't have to become Walmart greeters and police officers and somehow got on their knees and begged to keep their job after losing 90% of the money, they're back. They're doing the same playbook today, and the result is going to be this exact same result. So, it never ceases to amaze me. Okay, semi ETFs are averaging $4 billion a day. This always ends great for retail investors buying these at the top. Most extended since 2000. Semiconductors, look back to 2000. SpaceX from 220 down to 152. Just a week ago at 220, they're saying, don't you feel bad? You're not buying SpaceX. No, I feel great. Let me tell you, ladies and gentlemen, I feel great. Okay? SpaceX, share lockup implications present potential near-term liquidity uncertainty. You think? Okay, well, look at this. What do we have here? Performance trigger. Okay, so the tranches start Q2 earnings, day 70, day 90, day 105, day 120, day 135. It's just going to be a constant drum of stock dropped on the head of everyone who can't have enough. They're going to help you out. So for everyone who couldn't get enough SpaceX at 220, you're going to be able to get all you want at 80 and 60, because at 100, it's a ridiculous 100 times sales and losing $5 billion. It's a crazy valuation. But at 40 times sales and losing money, it's a bargain, right? Except there will be no bid. So, and when everyone has given up on it and given up on cooling Mars and, shipping people to Mars because, that's the highest and best use of capital, and no one wants it, then it might be interesting, because betting on Elon Musk has been a smart thing to do. Just not betting on him at the valuations that they went out at after all the growth was already harvested in the private markets before it was sold to the bag holders in the public markets. Wealth up $6 trillion, wealth by spiral, inflows into tech stocks, again, peakish stuff. Economic activity running strong in nominal terms, no sign of deterioration of a typical recession. Amen, hallelujah, we agree, and I think the stock market's going to start to reflect that. The 47% of weighting, which is AI stocks, are going to take a breather. That's going to hurt the indices a little bit. Everything else is going to start to get bid. People are going to make a lot of money on the surface because Main Street is going to be on fire. Wall Street is going to have a little bit of volatility for everyone who is crowded into the flavor of the month. Baskin-Robbins style Wall Street fashion show. The story stays the same. It just repeats over and over. Gas prices collapsing. That's good for consumer stocks and sentiment we've been talking about. Dollar got a little bit strong here. This is a counter trend rally that's to be faded into the end of the year. Retail inflows into stocks have jumped higher. What could go wrong? It's jumping into all the things that have already made their moves. Typical distribution will occur before you know it. Will it be in June and July? I don't know. July tends to be a stronger month in the market. August, September, October, I'd be a little worried. 10-year yield by Fed chair, so it's staying up around this 450 level. Our bet is lower before the end of the year and probably below 4%. Non-consensus view. We shall see. Credit markets still subdued. You're starting to see a little bit of bubble up in private credit. We're watching it closely. AI's long-term productivity potential. That's the potential, not yet the reality. We actually believe in this potential, and we will take advantage of any culling of the herd in coming months as some air comes out of it short term in the 5th inning. Not the 9th inning. We're probably in the 5th inning, ladies and gentlemen. Chinese AI models have rapidly gained traction. People are looking for these cheaper models. Who has the best model? Alibaba. Check receivers versus check writers. Again, this divergence. We believe the receivers are going to collapse down to the writers because the writers are going to stop writing the checks in the scale and the commitments that they say they're doing. Semiconductors percent of S&P weight is at all-time highs. It's now at 18.8. Even at the 2000 top, it never got above 8%. Implied volatility, retail options, again, record-breaking, going back to the meme trade. Semiconductors are the new meme trade. We know how that ended. Micron is the new GameStop, by the way. You can quote me for that. That is probably the most important thing that I'm going to say. Micron is the new GameStop, and we're going to see how that ends by the end of this year. An average year for the S&P and VIX, equal weight versus market cap weight. There's your opportunity, buying the equal weight again, as was working in the beginning of the year in spades until the war, blah, blah, blah. IT, again, over and over, just burdening ourselves with the facts, ignoring the short-term noise, and positioning ourselves to reap a harvest. Domestic box office, that's all Disney. Amen, hallelujah. Again, exposure to semis. Oil prices coming down. 10-year yield rising a bit. That's from Fundstrat. Debt yoke is still light. Household debt service payments as a percentage of disposable personal income. So the consumer is the most delevered that they've been in 45 plus years still. This is margin debt to M2 money supply. You got to go back to 2007 and 2000 to get this much margin debt. It's all in the new GameStop trade, which is global semiconductors, the most overcrowded trade in a long time. And when it reverses, it's going to be violent. Moving on, dollars repeating Trump's first term. Okay, who's that from? TTI. I don't know who they are. Quality versus momentum, semiconductor index. Again, same type of peak like in 99, 2000 in terms of the parabolic returns are equivalent right before it collapsed and retraced the entire move, which means some of these stocks, you're going to lose 80, 90% in a short period of time. AI mega caps are shedding trillions in June. Amen. We know that. We talked about it, pounded the table on that last year. Everyone thought we were silly when, you got Berkshire buying $10 billion of Google, literally top tick to the day. That wasn't Buffett, I guarantee. That was not Buffett. Okay? Berkshire's best days are in the rearview mirror without Buffett. He's one of a kind. It will never be replicated in that way. And that's that. Institutional clients had their second biggest selling week ever when normalized by market cap. June swoon is historically right now. That's from Dietrich. U.S. business activity gauge rises to the 5-month high. So what he's talking about here, this is Pulse, our BCA research. Non-tech stocks rose 11% after the tech bubble burst in March of 2000 and peaked in May of 2001. So while S&P was down 55%, tech stocks were down 80 to 90% in the NASDAQ. Non-tech stocks were up 11% during that period. So relative outperformance of 101%. Again, I don't think we're getting that type of correction in tech generally, or even the S&P like we did in 2000, but I do think you're going to get it in certain of the semiconductor stocks and memory stocks pretty aggressively and pretty violently. Consumer homeowner sentiment rises. Oh, consumer homeowner sentiment rises. That's good for home builders. Strait of Hormuz traffic collapse in Brent oil prices. Red Book Index, discount for non-US stocks. By the way, I wouldn't be surprised if you never hear another word about Iran, the way if you never hear another word about Ukraine, so long as those ships are moving through the Strait of Hormuz. I think that is over. I know there's a 60-day deadline, but don't count on hearing anything before the end of the year, that's for sure. U.S. net capital flows, Max 7 versus the S&P 500. Again, triple head and shoulders top. That's from All-Star Charts. That's kind of interesting now, breaking below that. So maybe there's some more pain to be had there. Levered ETF 8 AUM growth. What could go wrong? $200 billion of triple levered ETFs. We know who's holding that. China electric vehicle exports, where every S&P dollar goes. 40 cents to the top 10, 33 cents to Mag 7, 18 cents to semis. That's from Isabel.net via Citadel Securities. Strait of Hormuz, we got that. Cash held. Wartime. Brent has erased all wartime gains. That's really positive. Tech capex percent of S&P 500. In the tech peak, it was 37%. Right now, it's 49%. Just to put it in perspective, the extreme. Cox Automotive, Moody's Analytical Vehicle Affordability Index down to 39.4. I think I saw this number today that U.S. SAR is supposed to be over 16.2 this year, or U.S. car sales. If that's true, that's going to be a boon for Cooper Standard. Joe Tsai on the future of AI, full stack value drives Alibaba's confidence. We agree they've been growing their AI business revenues triple digit for 12 straight quarters. Alibaba chip unit, T-Head triples capital amid AI hardware bet. We brought that on ourselves when we restricted them getting chips. They built them themselves. Tech stocks are tumbling on renewed fears of cheap Chinese AI. Cheaper Chinese AI models matching U.S. frontier capabilities by early 27 are fueling a tech sector sell-off. Microsoft's Satya Nadella says leading AI models are too pricey, and the company is even considering hosting cheaper Chinese AI. Analysts warn Chinese AI competition could reduce profits for U.S. tech firms, though it may boost hardware and data center demand. Yeah, they're not going to build those data centers in the U.S., but Asia and Europe, they're going to dominate it. Cheap Chinese AI models are quickly gaining consumers across the U.S. market. Quote, this changes things. DeepMind. DeepSeek. ZAI. And by the way, Alibaba owns a piece of all these Chinese AI companies, and Alibaba's own models are the best on many, many metrics. So Anthropic accuses Alibaba of, quote, illicitly accessing AI models, meaning they subscribed, reverse engineered, and used the best features on theirs. Is that illegal? I don't know, but what I do know is that they've been able to replicate the value at a fraction of the cost. So people actually like that, more for less. Alibaba files lawsuit against the Pentagon seeking removal from military list. It's probably a waste of money and time. 10 cents on the list, it's done nothing to impact their business whatsoever. B of A's Redler says defensives are ready to roar if AI trade falters. I would replace if with when. The question is, quote, the question is, who is going to pay for all this capital expenditure that's basically fueling Micron demand? And the answer is, it's going to be the end user who uses AI. What's the pricing power there? What's the willingness to pay? I think the profitability projections that you currently have look very, very optimistic. Why consumers are still spending less debt, more stocks. Piper Sandler's top economist sees big bounce in consumer sentiment as gas prices tumble. That's going to help all the consumer stocks, the VF Corps of the world, even the consumer staples of the world. When people feel good, they buy Planters peanuts and Vans. U.S. online spending hits $8.3 billion as Amazon Prime Day kicks off. Oil retreats to pre-war levels as Gulf flows through Hormuz pick up. Treasury Secretary Bessent says U.S. GDP growth can return to 3% before the end of the year. By the way, his initial projections were 6 to 8% or 5 to 8% at the beginning of the year. The war set that back. World Cup could boost the economy by $45 billion, dwarfing the Taylor Swift effect. The hugest activation within that is Diageo and Guinness. So we'll be seeing those numbers. U.S. manufacturing hits 49-month high as, quote, input costs show signs of cooling. So the assertions of peak inflation may prove to be true. U.S. consumers favor home buying over renting for the first time since 2023. Bank of America study shows. Cox Automotive price drop and income growth improve new vehicle affordability in May. That's what we need for volumes for Cooper Standard. Toyota threatens GM sales crown as U.S. hybrid demand surges. That's good for Cooper Standard. They make a lot more per car that is a hybrid or EV versus an internal combustion engine. Disney's Toy Story 5 marks the biggest movie debut of 2026. And here is an interview in Wall Street Journal. You can look it up, which was, well, there was an interview with Mark Grether, who runs the ad business. Here it is. PayPal ad executive explains how shoppable ads are disrupting retail. PayPal Ads SVP and General Manager Mark Grether discusses the launch of the power of transaction-based shoppable ad units. Grether explains how consumer shopping habits are shifting away from traditional search engines toward AI models and why trust remains a critical factor for older demographics. This guy, as we discussed last week, and by the way, if you missed last week's podcast 348, just stop listening to this one and go back and listen to that. That was one of the best of the year and a lot of data. But we talked about Grether in detail in line with our PayPal thesis and what he did for both Amazon, generating half of their operating earnings from the ad business, and what he did at Uber, a couple $1 billion business at 75% margins with ads. And he's doing it now for PayPal. No one's got it priced into their models. Etsy's anti-Amazon ad campaign might be its smartest move yet, where they say shop from non-billionaire Jeffs and millions of other people selling on Etsy. So Etsy's been hitting on all cylinders and the stock continues to go up, now up like 60% in a few weeks. Vans releases K-pop Demon Hunters collection inspired by hit song Golden. By the way, I didn't have the pictures. I had more visits. I visited Vans Fifth Avenue like 4 times while I was in New York, and busier and busier and busier. And I talked to all the sales agents. They're like, yeah, we're super busy. So that's exciting to see. U.S. health spending to top $6 trillion in 2026 on the GLP-1 wave. Pfizer's going to get a big piece of that with the once a month Metsera play. They're the only game in town. So we're excited for that. All of the money flooding into AI is a giant warning sign. This is an article in the Wall Street Journal from James McIntosh. When companies as a group turn into sellers, it's a reasonable sign that stocks are very overpriced. Companies have a choice. Legendary investor Ben Graham thought of Mr. Market as a manic depressive, offering daily prices to investors, sometimes far too high, you should sell, and sometimes far too low, you should buy. Mr. Market also offers companies the opportunity to buy from or sell to us investors, and when they issue stock, they are choosing to sell. And you can see they're selling stock at a pace that's much higher than at the 2000 peak. And people, when the ducks are quacking, feed them, and the ducks are quacking as loud, and they are making some seriously fat ducks that are going to get out to slaughter. Wall Street pushes U.S. regulators to further ease bank capital rules that will increase credit, that will help Main Street and regular non-AI businesses, manufacturing, etc. Shipping and shingles, stock market, and sentiment results. This is our article of the week on GXO and QXO. For newer readers, here is a quick overview of the key drivers behind our thesis on GXO, the world's largest pure play contract logistics provider and one of the cleanest ways to play the restocking cycle against a backdrop of powerful secular tailwinds. GXO kicked off 2026 on the right foot, posting a strong first quarter that beat expectations across the board. Revenue of $3.3 billion, up 10% year on year. Top consensus by 80 million, with the all-important organic growth figure accelerating to 4.1% from 3.5% in Q4 as every region contributed. Adjusted EBITDA of 200 million, up 23% year on year, came in 20 million ahead of consensus, with margins expanding 60 basis points to 6.1% and helping drive adjusted EPS to 50 cents plus 72% year on year, well ahead of the 37-cent street was looking for. These strong results, combined with the contractual high visibility nature of the business, gave management enough confidence to raise full year guidance after just one quarter, lifting both adjusted EBITDA and EPS, the latter now implying 22% growth at the midpoint. What makes that confidence even more impressive is what's behind it. This isn't guidance built on a rosy assumption of a volume recovery, despite signposts that suggest we're still in the early innings of the broader logistics upcycle. Instead, management continues to assume flat overall customer volumes for the year, a posture Kelleher has repeatedly called prudent. The primary driver behind the raise is the growing commercial traction GXO is seeing in North America. The company's top strategic priority under Kelleher, if you remember, he ran DHL US, so he has all of these relationships, and arguably its single largest lever to reaccelerate organic growth. At just 24% of revenue, $3.2 billion against a $250 billion TAM, North America remains GXO's largest opportunity. If you recall, the vast majority of their revenue currently comes from outside the US. It's a market the company has long underperformed in, and one Kelleher has brought into fix, having previously led DHL Supply Chain North America. Early signs of progress are already showing up in the numbers, with the North American pipeline increasing 35% sequentially and helping lift the total sales pipeline to 20% to a record high of 2.7 billion. Perhaps even more encouraging than the headline growth is where those wins are coming from. 40% of the 227 million in Q1 wins came from strategic growth verticals, including industrials, life sciences, technology, and data centers, and aerospace and defense, where GXO landed its largest single contract of the quarter with an A&D customer in North America. This is the strategic pivot Kelleher set out to execute from day one, now starting to show up in the numbers in his third full quarter at the helm. Now to the elephant in the room. The big story heading into earnings wasn't GXO's results at all. It was Amazon. Amazon built a massive supply chain for itself. Now it's for hire. Just 2 days before GXO reported earnings, Amazon announced the expanded supply chain offering, opening its logistics network to third-party shippers beyond marketplace sellers. In typical manic fashion, Mr. Market wasted no time pricing in a crack in the GXO moat, sending shares down as much as 18% on the news for the worst single-day decline since the company became public. This shoot first, ask questions later reaction is a textbook example of the voting machine nature of public markets in the short run, creating exactly the type of dislocation we look for while we wait for the weighing machine to have its say. As we'd expect, management's reaction to the announcement was far more measured than the market's response. In fact, Kelleher framed Amazon's entry not as a threat, but as a validation of the market opportunity. The reality is that contract logistics is a nearly $500 billion market, with only 30% currently outsourced to 3PLs like GXO. There's simply too much runway left in the market for this to be a winner-take-all outcome. Even with Amazon's expanded offering, the model remains largely volume first and standardized, focused on selling access into the spare capacity of its own network. GXO, by contrast, operates a fundamentally different model, providing customers with standalone customized logistics solutions supporting highly complex operations. These relationships are sticky by design, with average contract durations of 5 years and customer retention rates north of 95%. Beyond the operational complexity that standardized solutions don't address, there's also a trust component that shouldn't be overlooked. You'd be hard-pressed to find enterprises willing to hand the keys to a potential competitor with full visibility into their inventory, demand, and financials, a structural advantage for a pure play like GXO. The only real overlap is GXO Direct, the company's shared use e-commerce offering, which grew 5% in the first quarter and accounts for less than 6% of the total revenue. These factors, along with GXO's limited overlap, give us all the comfort we need that competitive fears are overblown. Looking past the Amazon noise, we continue to view much of what the market sees as headwinds in the current environment as tailwinds for GXO. Geopolitical tensions, supply chain disruptions, tariffs, and reshoring initiatives all increase operational complexity for businesses and, in many cases, force full logistics network redesigns. With supply chains getting more complicated and the cost of getting them wrong rising, handing the problem to a specialist starts to look increasingly attractive. With 70% of logistics still managed in-house, the potential customer base remains a $500 billion plus market that only gets larger as supply chains become more complex, not to mention in a market increasingly focused on separating AI beneficiaries from AI cost centers. It's hard to think of a better positioned beneficiary than GXO. We have long believed that if AI truly becomes the productivity boom investors have priced in, many of the biggest winners will be boring, everyday businesses that can apply it in practical ways to drive productivity and profitability rather than those left funding the build out and footing the bill. For GXO, that opportunity comes through in GXO IQ, the company's proprietary AI-powered warehouse operating system, which moved from pilot to global rollout this quarter and remains on track for 50 plus sites by year-end. The platform now includes 8 AI modules deployed across labor planning, inventory movement, forecasting, and workflow management across both customer operations and internal functions. Clearly, there's plenty to be excited about when it comes to GXO today, with the next major catalyst being the long-awaited Investor Day under Kelleher, scheduled after third quarter earnings. That's where the market will finally get a roadmap for what a structurally higher margin base looks like and how organic growth can re-accelerate as the restocking cycle continues to play out. We suspect it will also be the point where investors begin to wake up to the secular drivers we've been pounding the table on. Until then, the things we care about most, accelerating organic growth and margin expansion, are precisely what GXO is delivering under Kelleher, and we look forward to what should be an important Investor Day later this year. So we've broken down the earnings, we posted all the key points, we've highlighted them. Read them at hedgefundtips.com, and you will be glad you did. 10 key points you can go through at your leisure, along with the key points in the earnings call transcript and analyst questions. Moving on to QXO Logistics. For newer readers, here's a quick overview of the key drivers behind our thesis on QXO, Brad Jacobs' latest venture and one of our favorite arms dealer plays on a U.S. housing market recovery. QXO's first quarter came in line with few surprises, with continued weakness across the building products industry weighing on the near-term results amid elevated mortgage rates and a subdued residential backdrop. Net sales came in at $1.73 billion, 9% below legacy Beacon's $1.91 billion in the prior year period, while gross margin of 23.7 ran 80 basis points below Beacon's standalone 24.5. Combined with elevated spend across systems, sales capacity, and personnel, the near-term print is exactly what you'd expect in the early stages of the integration cycle at a cycle trough. As we have said from the beginning, the QXO investment case was never about any single quarter and has always been about the roll-up strategy across the $800 billion building products distribution industry, with Brad Jacobs targeting $50 billion revenue platform over the next decade. In fact, the longer housing remains in the gutter, the more attractive the pipeline of high-quality assets becomes, giving QXO the opportunity to shop from the industry's clearance rack while waiting for the cycle to turn. On that front, the quarter's real news broke weeks before the print rather than in it. On April 18th, QXO announced a definitive agreement to acquire TopBuild, the largest distributor and installer of insulation in North America, for an enterprise value of $17 billion, expected to close in Q3 26 and be highly accretive. The transaction is QXO's biggest swing yet toward its goal of reaching $50 billion in revenue platform, following the $11 billion acquisition of Beacon Roofing in early 2025 and the $2.25 billion purchase of Kodiak Building Partners that closed on April 1st. Below, Jacobs joined CNBC shortly after the announcement to discuss the deal in detail and what the combined platform will look like, with the full interview included below. You should read that, listen to it at hedgefundtips.com. Strategically, the TopBuild acquisition is a game changer for the QXO story, starting with scale alone. The combined company has generated $18.1 billion of revenue and $2.1 billion of adjusted EBITDA in 2025, with a combined enterprise value knocking on the door of $50 billion. The deal vaults QXO into the position of the second largest publicly traded building products distributor in North America, only behind Ferguson, while adding $6.2 billion of incremental revenue and expanding the platform to a $300 billion plus addressable market. It also extends the leadership across key categories, with number one positions in insulation and waterproofing, number two in roofing, and number one or number two positions in lumber and building materials across key geographies. The combined platform also shifts toward a structurally higher and more durable earnings profile. Right now, QXO operates at an 8% EBITDA margins with heavy exposure to residential markets and 80% of the mix tied to repair and remodel. TopBuild, by contrast, brings industry-leading 18% margins and greater exposure to commercial and industrial end markets, including data centers, airports, warehouses, and stadiums. The result is a more balanced mix, shifting toward a 50-50 split between repair and remodel and new construction, in turn creating a combined 12% margin profile and leaving the company far less dependent on a purely residential cycle. The final piece is proximity to the job site, arguably the most underappreciated aspect of the combined platform. TopBuild's installation businesses places QXO on 22,000 job sites daily, and in turn providing real-time visibility into construction activity and demand patterns that supports cross-selling and higher wallet per share per customer. It ultimately moves QXO toward a true one-stop shop, able to bundle installation, roofing, waterproofing, and building materials into a single relationship for builders and contractors who would rather manage one supplier than five. The market has yet to embrace any of these upside drivers. Combined with the broader backdrop of higher rates and ongoing input cost pressure, QXO shares have remained under pressure since the announcement. The debate comes down to 2 points of contention, both of which we view as overblown. The first is price. Beacon was acquired at 10.5 times EBITDA and Kodiak at 10.7 times, making TopBuild at 14.9 times look at first glance like a stretch. We see it differently. Beacon was a fixer-upper, an underutilized asset bought to be improved through pricing discipline and procurement. TopBuild is the opposite, a best-in-class operator already running 18% margins, acquired not for what can be stripped out of it, but for what it brings to the platform through cross-selling and commercial synergies, including the expected $300 million of run rate synergies by 2030. The effective multiple steps down to 11.8 times, with further upside from execution over that time. On that basis, it looks like a fair price for a high-quality asset, especially in the context of QXO's cost of capital, which brings us to the next point. The transaction is financed with $7.9 billion of new stock issued to TopBuild shareholders, $6 billion of new debt, a $1 billion preferred draw, and the remainder from cash on hand, leaving TopBuild holders with 19% of the combined company on a fully diluted basis. While we are never fans of dilution as shareholders, this has to be viewed in the context of QXO's cost of capital and the broader capital arbitrage strategy at work. Jacobs has run this framework across every platform he has built, raising equity ahead of large moves and issuing it at strength, then using it to acquire high-quality assets at cheaper relative valuations. In the case of QXO, management issued the equity at $23.80 in January and struck the top billed equity component at an implied $25 a share compared to the current share price of $16.94. For those concerned about dilution, just ask United Rental shareholders who were rewarded with a greater than 200x bagger, or XPO shareholders who saw a 50x bagger for stomaching it during the build-out phase. Not to mention, Jacobs remains the largest single shareholder following his personal $900 million investment, with any dilution occurring alongside shareholders rather than over them. At the end of the day, Brad Jacobs continues to execute on the QXO strategy he set out to build. The goal of reaching $50 billion of revenue and $7.5 billion of EBITDA within the next decade remains firmly intact, with the combined Beacon, Kodiak, and TopBuild platform already locking in over a third of that trajectory just 18 months into the platform's formation. From here, and while we wait for the housing cycle to turn, the focus shifts from transformational M&A to integration and execution, though anyone who has followed Jacobs over the years knows a great deal will never be left off the table. So here are the key slides from QXO and the Q&A on the deal, as well as the quick Alibaba update. Let's get to that. We wanted to put out a quick update on recent headlines and noise around Alibaba and other Chinese equities. A steady stream of so-called headwinds, many of which we view as overblown, has weighed on sentiment. In no way has it changed the fundamental story of our investment case. We've used recent weakness as a buying opportunity and continue to lean in. Below is our latest Alibaba deep dive, along with brief commentary on key recent headlines. Pentagon military list designation. Alibaba was added on June 8th to the US DoD, Chinese military companies, alongside BYD, which is a car company, by the way, Baidu, joining nearly every major Chinese tech name, Tencent, Huawei, DJI, etc. The designation is procurement related, carries no sanctions, and doesn't affect normal business operations in the US or elsewhere, given no exposure to US defense procurement. Alibaba has filed suit, arguing the listing is a mistake with no basis. Similar designations have previously been successfully challenged and removed. Xiaomi, while inclusion on the list makes for a headline, it has zero revenue or earnings impact. 618 subsidy crackdown. The 618 mid-year shopping festival came in softer amid ongoing regulatory pressure on excessive discounting across e-commerce platforms. Ahead of the event, regulators met with 5 major platforms on subsidies, false promotions, and, quote, cutthroat competition, continuing the push away from subsidy-driven growth that has eroded margins across this sector. This follows draft rules from the State Administration for Market Regulation targeting prolonged subsidy programs in food delivery and instant commerce. While the market's initial reaction was negative, we view the crackdown as a long-term positive, with the subsidy war that has weighed on Alibaba's profits likely past peak and earnings growth set to re-accelerate. China AI ecosystem. While money has rotated away from Chinese internet and consumer names in favor of AI quote-unquote pure plays, investors seem to have forgotten who sits at the center of the Chinese AI ecosystem. It's Alibaba. As China's number one full-stack AI player, Alibaba combines the country's number one cloud platform, 38% market share, larger than the combined share of the next 3 providers, proprietary chips, leading open source models, and strategic stakes in names such as Zhipu, Minimax, Moonshot, and 01.AI through compute for equity arrangements. The irony is that many of the AI quote-unquote winners attracting investor attention today are backed by Alibaba and run on the Alibaba cloud. Shares of Zhipu are up 2,000% this year, and Minimax has gained 260%, yet both sit squarely within Alibaba's ecosystem. To put the disconnect into perspective, Zhipu now carries a market cap of $130 billion, despite generating just $105 million of revenue in 2025. By comparison, Alibaba Cloud alone generated $22.9 billion of revenue last year, while Alibaba as a whole generated $148 billion of revenue and carries a market cap of just $240 billion. Complete silly season. Consumer weakness. China consumer confidence has fallen to one-year lows, while May retail sales declined 0.6% year on year, marking the first contraction since the economy reopened in 2022. We continue to view this as cyclical rather than structural issue, with weak sentiment creating the potential for additional policy support to drive a recovery. Meanwhile, the market remains fixated on near-term consumer weakness, despite cloud and AI increasing driving the story. Government data centers. China's $295 billion data center build-out over the next 5 years sparked concerns that government-funded capacity could undercut private cloud operators, with Alibaba the most exposed. Analysts at Citi pushed back on this view, and we certainly agree, arguing the reaction is overdone and not a zero-sum outcome for hyperscalers like Alibaba. Capacity is expected to broaden AI access for state-owned companies and smaller businesses that cannot afford higher token costs, while private players continue to serve higher value enterprise workloads. Rather than a headwind, this could be even be additive for Alibaba via lower capex intensity and greater flexibility to allocate capital towards chips, models, and higher value AI services and buybacks. Just as we have been leaning into weakness amid the headline-driven volatility, management has followed suit with reinstated buybacks, with Alibaba repurchasing 1.9 million shares over the past 2 days, with a net cash position of $38 billion, $59 billion excluding long-dated debt. The company continues to have plenty of dry powder to retire more cheap shares should weakness persist. General market fear and greed index at 28, so a little fear is coming into the market as people get hurt in tech. National Association of Active Investment Managers, a little bit of selling there, but still overweight. And moving along to earnings, oil and gas, equipment services earnings, top 30 weights in the last 60 days. Earnings are revised up 3.93% for this year, up 6% for next year. ARK Innovation Fund earnings estimates. This is the Cathie Wood Fund. The cumulative earnings estimates have been revised down 5 basis points for this year and up 3.48% for next year. As far as economic data this week, core PCE price index came in as expected, 3.4%. Core PCE month on month, 0.3% as expected, and GDP came in better than expected at 2.1 versus 1.6. On to the Ask Me Anything questions from our incredible audience, and then we'll wrap it up for this week. Back to normal for next week, so let's get to a few of these. Ryan Long asks, Alibaba, we covered. Alan Price asks, Alan here from London, only discovered you a couple months ago through a friend, but I love your podcast and been sharing it literally with everyone I know. Thank you so much. What are your thoughts on regional REIT, RGL? I don't really have an edge on British REITs, but let's pull it up. Free cash flow is showing no signs of recovery yet. Revenues are showing no signs of recovery yet. They've added a lot of shares, up from 51 million to 162 million. So I don't know, 3 strikes and you're out. Let's just see how battered the stock is. Yeah, no, I'd pass on this. These guys have been diluting their owners forever. Bad operators. You can't make a good deal with a bad person, and these guys have not been good. All right. Next. Wait a second. Oh. Here we go. There we go. Okay, Kyle M. What do you think about Keyman risk for QXO with Brad Jacobs? Less than Keyman risk with... No, because Brad has always cultivated leadership and stepped back from all those things. I mean, United Rentals continues to hum without him. QXO continues to hum without him. His connections thing continue to hum without him. So less than you think, especially with all that he's gotten done already. Daryl M. I mean, Tesla and SpaceX would literally go down 99% if something happened to Elon Musk. I don't think that would be the case with Brad Jacobs' companies. He built them well. Daryl M. GPK. Okay, let's take a look. Looks like they're starting to recover a little bit with free cash flow. It's been a low returning business for a while. $5 billion of debt. I just don't think, it's $10. For me, this would be a pass. I don't like this balance sheet. Let me just double check it. Maybe, let me just take a look. For business, it's kind of a slow grower to take on that much leverage, 190 million of debt, 800 million of receivables. And $5 billion of debt. I don't really want to mess with that leverage for that limited of upside. Hong Kong stocks, we covered it. Tyler Mason, you think Netflix is going to continue to drop? I don't know. I don't own it. NFLX, let's see. I don't think it's really come down a lot. I know it's down like 50%, but I personally wouldn't be a buyer here. Cash flow continues to grow. Talk to me at 40 to 60 range. I don't think we'll get it, but that's when I would get interested. I need triples, okay? Comstock Resources, we've been buying all week. Lowest cost producer. Daniel Borkman, it's going to fuel the AI revolution, which is in its 5th inning. Covered that about Anthropic. Surprised I'm getting questions on Baba this week. Wink, wink. Evan Vetter. How do you look a stock who you thought could have legs for a turnaround and then the next day retail meme traders pushing it up with a short squeeze? From that point, is it over, or could there be a time that the meme momentum disappeared and price returns to fundamentals? The price always returns to fundamentals. Why? What's happening with Jack in the Box and Wendy's? What are you talking about? It hasn't even begun. I think these are buys, by the way. All these beat down restaurant stocks. It's not over. None of these are over. They're just starting. Restaurants are just starting. It's consumer sentiment trade. Lucas Fies. Lucas Fies. For PayPal, aren't buybacks a negative if the business is in decline? Well, you have to define decline. Revenues are growing. Free cash flow is growing. Revenues are at a record high. Free cash flow is near at a record high. Margins are turning back up, not down. And the ad business hasn't even dropped in $1 billion to $1.5 billion of free cash flow, which is coming in the next few years. So your definition of decline is based on feelings around price, not fundamentals. And in the short term, the market is a voting machine based on emotions. In the long term, it's a weighing machine based on fundamentals. Fundamentals are improving. Price is not. This is how we make our money, by being patient when no one else is and selling based on emotions versus burdening themselves with the facts. Thank you for the question. Brian David. Tandem Diabetes. The diabetes business is a low margin business. I don't like it, but a lot of them have become cheap enough that they're attractive at these levels. It's low margin and slow growth. It's almost like a runoff business. They haven't really turned the corner on free cash flow. Let's see what's happening with DaVita. Yeah, Tandem's not really for me. Let me just take a look at. I mean, this has just been such a poor performer for decades. Negative free cash flow. I just don't want to be in a business like that. I mean, all right, Michael Costa, Olin, is that it's a chemical company? Probably a good one. Yeah, I think that'll probably be okay. OLN. It's going to take longer than you think, by the way. It could be dead money for 2 years before it turns, but I think you're going to be all right with that one. I'd be much more interested between 10 and 15. We may never get it, but I'm not an eager buyer at 25, to be honest with you. I buy or sell, gun to the head, I'd be a buyer. Thoughts on coin? I have no edge in anything related to crypto. So for me, it's a pass. Next. Panos N. Thank you for your time and value. FMS, it's a medical care business. I mean, if you got to play, yeah, anyway, so, yeah, I don't think this one's going to give me a double or triple. It's already up a lot off of its lows. It's up double, but maybe long term. Let's see whether it's a compounder of any sort. It's kind of an annuity. The balance sheet's a little bit levered. Let me take a look at that. Yeah, I just don't see a double or triple in this over the next few years. So they got a 1.4 billion of cash, 7 billion of debt. So they're probably okay. I just don't see how you're going to make a lot of money in it. Andrew, EPAM is software. I keep looking at it. I can't get comfort around it. I think you're probably right. Thoughts on Wendy's? Yeah, that'll probably work. Restaurant group is going to rip. Whirlpool, is there any price you'd consider looking for a new jockey? Yeah, I'm looking for a new jockey. What a whiny little bitch got on his conference call complaining about the economy is the worst demand since the great financial crisis. Well, get off your ass and go out and create some demand. People need dishwashers and they need refrigerators. And if you're not getting any of it, shame on you. I mean, this is an opportunity for you to pick up share, get off your ass and advertise. And then when the cycle comes back, mint money. And instead you're whining like a little baby. So that said, I keep looking at it every week. I do want to enter it at some point, and I do think you're going to make some money. And probably the catalyst will be when he gets shit canned. So I can't believe this. How do you destroy this? Like this guy, well, down 25%. Revenue's down 25%. That takes, you got to work 24/7 to have your revenues decline 25% in a few years from a business that's been around for decades upon decades. But he figured out how to do it, and now he's blaming everyone else. So yeah, there's your catalyst. Alex P. Wendy's fine. I'm not in love with that. It's like a third-rate burger, but yeah, they'll be okay. Ricardo Bustamante, ATRO. ATRO. This is probably, let's see. $159 times free cash flow. I mean, you're top ticking it. I don't understand why you'd be interested in this. But welcome to the podcast. Yeah, I'd be happy to play golf in Puerto Rico as long as it's at Dorado. What do these guys do? Yeah, I mean, aerospace and defense. It's fine. You're just late. You're not going to make a triple from here. So, all right. Joe W. Grab. No. I get asked every week on that. Martin McAdams. Cal Maine Food. These companies should not be public. They should be private cash machines owned by a family that dividends out gazillions of dollars to the family. They should not be public companies. Banana companies should not be public. Egg companies should not be public. Milk companies should not be public. Fruit companies should not be public. These should be private, closely held, family-owned companies that make money for generations. I'm not a buyer here. It's already made its move, and these things don't move much, so hard pass. Robert Wart. I don't avoid banks. We made a fortune on Wells Fargo during COVID. It's just not the time to be a buyer. It's already made its move. We made a ton of money on Citigroup, which you're asking about. But now that it's up, you're interested, and that's not when we like to buy it. There'll be a time to buy banks. It's not now. Next, Mark Goodman, UHS. Again, like you'd be lucky if you make a double on these. So for me, it's not going to meet our 3 to 5 year IRR expectations. It's fine, but I mean, they're buying in stock, they're growing revenues. It's fine, but you're going to make maybe 50%, 70%. Kinsdale Capital, no view on that. Jay Martin, Mattel. Mattel is where money goes to die. Let's see, it's probably cheap again. Yeah, you're never going to make it. I mean, toy business. Some businesses you just avoid. You're not going to make great money there. I mean, you'd be super lucky. You have better chances of making a double in that one's going to be hard. Victor Fundheller. Danish Coloplast, COLL. Let's see. All right, the stock's down from 139 to 50, so it's fallen 50. Your margins are a little bit lower. Revenue's up, cash flow's up. The problem is, I want to know why they increased the share count. Looks like about by 12 million shares. The balance sheet, so it looks like they did a dumb deal with stock and debt at some point in 2003. Let's take a look at the balance sheet. It's probably okay. $165. Why is this quarterly? All right. $148 million of cash, $800 million of receivables, and they've got $1 billion of current. So they got $4 billion of debt and current with $100 million of cash. The problem there is a balance sheet. It's probably okay, but I wouldn't take that kind of leverage for a business I could only barely make a double on. So pass. Alexis. Thoughts on Roblox? Thoughts on Roblox? Yeah, they keep doing a lot of stock-based comp, but it's probably more interesting here than it's ever been in a long time, and no one's talking about it, which is when I get interested. But it is a level of software. I think it's more video games. Let's see here. So it's doing $7 billion of revenue. It's got a $31 billion enterprise value. What is expected? Negative EBITDA. I mean, it's still rich, but it's getting more interesting, that I will say, because the business keeps growing. So worth more research, but not a screaming buy. Chad Stetchman. Do I have financial advice for individuals? No, it's all opinion, not advice on the podcast. If you're a qualified client, you can reach out to us at greathillcapital.com or hedgefundtips.com. Send in your contact and we can talk and see if there's a match. To come in anytime for $5 million accounts and once a quarter for the minimum $1.5 million accounts, which we're going to open again for this quarter on July 1st. Bob Atkins, thank you for the content. ACN. Accenture, no. I mean, this is totally disintermediated by AI. Will it find a low at some point? Yes, but I mean, that she was on CNBC. She looked like a clown. I mean, I'm not gonna. It was the most. I felt sad for her. So they're gonna need better leadership and some way to not get completely disintermediated by Accenture. They'll figure it out, but I don't think it's imminent. Bob Atkins, same thing, unless it's the same question. June 21st, okay. Erie, E-R-I-E. Okay, Erie. Oh, Erie Indemnity. So the problem with a lot of these this is certainly a compounder. Operates as a managing attorney in fact for subscribers of Erie Insurance Exchange, issuance and renewal services, sales related services, agent compensation, sales advertising support, underwriting services that include policy processing, consist of administrative IT services. So it's like a service provider. Let me just make sure. Protection you need. Is this a carrier or just a service provider? Oh, AM best rating. Yeah. So the issue with a lot of these insurance companies is they are jammed with private credit. And you have to look carefully at what's in their portfolio because you're going to start to see more and more defaults in private credit. So that's the only issue. As far as their underwriting business, the P&C business is actually entering a softening period. So they had a historically hard cycle that peaked about 2 years ago, and pricing is now coming down, but they have to keep the volumes up. So they're writing uneconomic business, which is why we're kind of interested in the space, but it's early. And on this one, I would say, it's a long-term compounder. Maybe this is a decent entry point, but you got to really understand their portfolio before you become an owner. And I would be inclined to wait for a while because there's not really despondency yet in the group. Tommy Gaskins. We're calling for both consumer discretionary and consumer staples. Barb Markel. No, we're fine with Goose. Jasper bought some this week. Alex Carr. All of the above. Andy Digweed. All right. Started listening 3 months ago. Love the podcast. Love what you're about. Playing American Water. That stuff comes and goes. I mean, these water companies never really make... again, some businesses should be private. American Water. I remember guys who started up funds and blew up. It's just, some things shouldn't be public. American States Water. Which one are you looking at? I don't know. I guess he's looking at America States Water. Yeah, no, those companies are not interesting to me. Just ordered 2 of the t-shirts. Thank you, Nicholas. Can you take a look at ER? Well, Nicholas, the most important thing you can do, one, thank you for the shirts, but we only make a few bucks on each of them. That's not why we do it. Please wear the shirts and tell people about the podcast, which I'm sure you will do. But most importantly, put one on, send us a picture. Let's get you up on the website. Send a picture to info@hedgefundtips.com. ERII, Energy Recovery. Okay. It's a little bit falling knife-ish still, but let's take a look. Looks like the free cash flow is okay. Revenues haven't started to recover yet. Margins have been in a little bit of decline, but okay. Balance sheet looks okay. Buying in shares. I just need you to figure out and get on the calls. Water emerging technologies, high and low pressure, ultra high pressure changers, hydraulic turbochargers, etc. This is probably related to some aspect of housing. I think it's all right. Let's just take a look at the balance sheet real quick. 75 million of cash, 17 million debt. That's okay. Cash flow, I think, was pretty good. Yeah, I think it's okay. It might take a little while to build a base, but it's kind of interesting. Manny B. That's funny, but I'm not going to read that one online. Daniel Murphy. Yeah, we're good with CCI, and that's it. So with that said, we'll be back next week, back in sunny palm tree laden California. In the meantime, make it a great one. Bye for now.